Welcome to your masterclass on fundamental analysis. Master the stock market. Investing is not about guessing prices, it's about owning businesses. If you have 10 lakh rupees today, would you invest in Reliance, Infosys, Tata Motors, or would you simply buy whatever is trending on social media? Most beginners lose money because they buy stocks without understanding the underlying business. Today, I will show you exactly how professional investors analyze companies before putting their hard-earned money at risk. Welcome. In this lesson, we'll learn to distinguish between wealth creators and wealth destructors. We'll bridge the gap between hard numbers and the story behind the business. We will cover the two pillars of analysis, the qualitative story and the quantitative numbers. You'll master key ratios and understand what makes a company truly great through a real-world example. Fundamental analysis is about finding the quote-unquote intrinsic value of a business. As the saying goes, price is what you pay, value is what you get. We start by splitting our research into two parts. Qualitative analysis looks at the unquantifiable factors. What is the business model? Does the company have a moat, a competitive advantage that protects it from rivals? And most importantly, is the management honest and efficient? Once we like the story, we look at the scorecard, the financial statements. This is the quantitative side, where we analyze the hard numbers across the balance sheet and profit and loss statement. First, check the P/E ratio to see how much you're paying for each rupee of profit. Then, look at return on equity, or ROE. A strong company should ideally maintain an ROE above 15 to 20%. A common mistake is ignoring debt. A high debt-to-equity ratio is a red flag, especially for non-banking companies. You want a business that generates real cash, not just paper profits. Analyze the free cash flow, the actual cash left after expenses. Also, check the promoter holding. When the owners have significant skin in the game, their interests align with yours as a minority shareholder. Let's put this into practice with a gold standard of the Indian market, Asian Paints. Why has this company created so much wealth for decades? It's all about the moat. Asian Paints' moat is its incredible supply chain. They bypass middlemen to deliver directly to dealers multiple times a day. This efficiency translates to a consistently high ROE and dominant market share, protecting them from new entrants. But remember, even a great company isn't a good investment at the wrong price. Always look for a margin of safety. Check for red flags like frequent management changes or complicated corporate structures. To summarize, analyze the business model first, scrub the financial ratios for health and efficiency, and ensure the management is high quality. Use this checklist as your starting point for every stock you research. Investing is a marathon, not a sprint. By mastering these fundamentals, you are building the foundation for long-term wealth creation. In our next lesson, we'll dive deeper into sector analysis. Happy investing!